Hello, and welcome to this week's edition of Checks and Balances TV. Today's program is entitled, The Changing Financial Seasons of Your Life. Be sure your investments change with your age and goals. But first, let's see how today's news may impact your financial future. The S&P 500 dropped nearly 6% in the month of August, making this the fourth straight month in a row that this popular index has declined. And if the stock market volatility in August wasn't bad enough, major concerns about the economy in the U.S. and abroad carried over into September, with the S&P suffering its worst ever three-day start to the month. A key demographic in this massive sell-off has been baby boomers. According to a recent report from the Federal Reserve Bank of San Francisco, boomers have started pulling their money out of stocks and placing their savings into more conservative investments. With boomers making up a large part of our population, the report predicts that their selling of stocks could depress the market for years, with prices potentially falling another 13% over the next decade. Okay, so what's really going on here? Let's check the facts using our checks and balances process. Many economic factors have fueled the recent sell-off in the stock market, such as no new jobs being added in August, according to the Bureau of Labor Statistics, which, by the way, is the first time this has happened since 1945. Also, the national unemployment rate remained at 9.1%, and as a result of this disappointing news, the S&P 500 fell another 2.3% on the day the Federal Reserve Bank report was released. In addition, inflation reached its highest level since March of this year, with the Consumer Price Index rising 0.5% in July alone. Food prices have increased 4.2%, and gas is up 33% over last year. The recent study and report by the Federal Reserve Bank of San Francisco also suggests that this is only the beginning of what could be a longer-term stock sell-off by boomers, likely to last throughout the next decade. The report's basic premise is that stock prices have been closely related to demographic trends over the past half-century, namely the baby boomers. Between 1981 and 2000, the equity price to earning, also known as PE ratio, of U.S. stocks, or the price multiple of U.S. companies, has tripled. As boomers reached their peak working and saving years, they were willing to pay more for the earning potential of a stock. It was during those years that stock prices pushed higher and higher due to the demand by those boomers in their prime accumulating years of life. Now, as the eldest of the 76 million boomers reaches the traditional retirement age of 65, the demand for conservative investments is growing, and they're dumping volatile stocks to protect their savings as they head closer to the preservation years of retirement. Okay, so now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. With baby boomers selling stocks in masses, many are questioning what will happen to the U.S. economy as a result. Boomers, who control nearly 70% of the aggregated U.S. wealth in this country, are a very, very powerful group. The San Francisco Fed's report indicated that stocks would drop 13% over the next decade, and then take an additional 6 years, until 2027, for share prices to return to the level they reached last year. However, they predict that stock prices will rise sharply thereafter, and that by 2030 should be about 20% higher than in 2010. Of course, this is just one prediction, and no one really knows if this will in fact happen until we arrive in the year 2030. However, as we look at generations X and Y, they are following closely in the boomers' footsteps. They are currently in their accumulation years of life and quickly approaching their peak earnings years. We should also remember that one man's volatility is another man's opportunity. And while the economy may slow down as boomers scale back, the next generation is investing their retirement savings at a very good time as the market continues its downward spiral. Now, as boomers enter the preservation season of life and look into more conservative investments, insurance companies such as AIG, American Equity, and Allianz are continuing to see an increase in fixed annuity sales. Variable annuity companies such as MetLife and Prudential have experienced double-digit growth when compared to their previous year. Annuities typically provide a guaranteed income for life, and as a result have been very popular among retiring baby boomers. Okay, so what's the bottom line here? Retiring baby boomers need some kind of relief from the volatility of the stock market, and as a result are cashing in their investments and seeking more conservative, less stressful savings options. When the markets crashed in 2008, boomers lost more than $2 trillion collectively, money that was earmarked for retirement. With the recent market sell-off, it looks like many aspiring to retire baby boomers don't want to make the same mistake twice. The S&P dropped nearly 30% since 2008 and almost 11% so far in 2011. One's financial life should really be divided into 4 seasons. First, there is the accumulation season, where you work hard, save, and invest to grow your nest egg. The next is the preservation season, where you work hard to protect your life savings. The following season is the distribution phase, where you structure your life savings to provide an income to last throughout your retirement years. And the fourth and final financial season is the succession phase, where your remaining life savings is passed on to your loved ones in the most tax-efficient manner. So be sure you stay true to your 4 seasons of your financial life. And now for Matt's weekly financial tip, tool, or technique. Understanding the basic principles of the 4 financial seasons of life can help you define where you are today and the steps you will need to take in the future. Knowing specifically how to handle your money from one season to the next will ultimately determine whether you meet or exceed your retirement goals. So here are some key financial tips to guide you through the 4 seasons of your financial life. The first season is the accumulation season, which is basically ages 20 to 55. Accumulating wealth sets the foundation for your entire life, including every season that follows. Setting goals, saving and investing consistently, developing tax-saving strategies, and structuring your retirement plan as early as possible will allow you to keep more of your hard-earned savings throughout the following seasons. The second season is the preservation season, basically between the ages of 55 to 65. In order to successfully preserve your assets during this season, you should reduce or eliminate most investment risks, but still look to earn better than average returns. You also want to work hard to reduce unnecessary expenses, fees, and taxes from your portfolio as well. The third season is distribution, ages 65 plus. Sufficient income planning is the most important consideration of this season as you determine how to make the most of your financial nest egg. Your goal here should be to maximize income while reducing your tax liability. And the fourth season is succession, after your death. Again, taxes need to be considered here as well, as you also plan on how to pass on your remaining nest egg and savings to your loved ones. You worked your whole life to get to this point, and your legacy will depend on how well you planned your finances in each of the previous seasons, and also what estate planning you have prepared in advance. So as you can see, each financial season of life builds on the one before it, with a successful retirement hopefully waiting for you in the end. And planning each season carefully in advance will help you get the most out of your financial life. Be sure to log on to our website and request our featured free report in our Truth About series. It's entitled The Truth About Retirement, a free report that gives you the information and tools you need to prepare yourself for a financially secure retirement. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Reddick from Checks and Balances TV. Until next week, dump debt, invest wisely, believe in yourself, and make it happen.